Okay, so I had made an earlier video, but that only recorded as an audio. So I'm hoping this one records with the video as well. So going back with the first video that for you to watch this video, you please watch the first video. If not, stop this video right now and find the first video. So I'm just going to go over the things I went over in the first video, but with the extension, because this video I'll be covering how to take your trades, where to place your stop loss, and where to place your take profit. So generally speaking, for the new traders, the beginners, even if you're an advanced trader, but this is your first time trading market maker method, everything I'm showing you right now will work predominantly for New York session and sometimes in London, where you get multiple hits to the high or to the low. So just some quick tidbits. If you guys didn't already know this, I'll give you this information. The market sessions that you see on Google and on the internet and whatever, all of that's crap. Complete, absolute crap. These are the market maker times. Dead market time is from 5 p.m. Eastern to 8 o'clock Eastern. Then the Asian market makers come on during the gap time, which is 8 o'clock to 8:30. This is where they get the instructions from the liquidity providers where they need currencies to be moved to. From 8:30 to 3 a.m., Asian session is on. From 3 a.m. to 3:30 is another gap time where the London traders come on and the Asian traders are leaving, which means the Asian traders are letting the London traders know exactly what's going on, what they're doing. We got $500 million trapped at the high of 1.31201. Go near that level, but don't release the traders. Move it down 30, 40, 50, 60, 70 pips. And the London traders come on from 3:30 a.m. to 9 a.m. and the gap time for New York traders is 9 a.m. to 9:30, and the New York session starts at 9:30, which is in line with the U.S. equities market to 5 p.m. So that's the time. Any other time you see in the market is complete crap. It's put in there to get you going the wrong way and trading the wrong directions. As I release more videos going into the future and I move from beginner into intermediate into advanced, you'll be able to get a much comprehensive knowledge. All right, so let me get into it. If you've seen the first video, you see I talked about how to backtest. So when you're backtesting, now we're going to take each scenario as an actual live day trade. This is exactly how I look at it. Only difference is I don't do it on TradingView. I do it on MetaTrader 4 with all the templates already set up. My boy Hans just got the video I sent him, so that's good. Now, going on, we talked about the Asian range being where the market makers set the initial high and they set the initial low. So highest point of Asia, lowest point of Asia, that's your range. Ideally, you want this range to be about 50 pips or less, so that way you can clearly see the stop hunts. Because the whole thing about the market is a misdirection. So you just have to know that. Now, London traders came in, extended the low of the day to right there, and they extended the high and they put the high right here. Now, you want to take the trade after the second hit to the high. I would have taken the trade right here, and here is why. Now, I know that this is gap time. Remember I talked about gap time, which is between 3 o'clock and 3:30. This gap time is where they send traders going the wrong way. This is where all the other technical traders and every other trader that doesn't have this time frame I just gave you, you guys really don't understand how important this time frame I just gave you is. Now, everybody else coming in thinking London starts at 3 a.m., they all see this wicks to the high and they're trying to either buy it or whatever it is that they're thinking. You know now that until you see the second hit to the high of London or New York, that's only when you're taking that trade. So here you go. You want to take this trade at the high, you're shorting it, you want to enter right at the high. If you enter at or near the high, that means you're selling the trade. If you enter at or near the low, it means you're buying the trade. So your trigger to buy is 2 hits to the high, or sometimes 3 hits to the high. That's a trigger to sell. Your trigger to buy is 2 hits minimum to the low, or more. Now, here, once you take the entry at or near, usually you want to wait for this candlestick to close. You enter right here. Since you're entering at the high of the day and not a formation like a head and shoulders or an M pattern, which your stop loss is going to be 23 pips plus spread. You have to account for the spread, because that's how the market makers move the market, and they widen the spread and extend the spread. That's where they can grab your orders and move away from it, gets you trapped in consolidation and going the wrong way. So if your spread for the pair is 2 pips instead of 23 pips, now you have 25 pips. Now, if the take profit for market makers are all 50 pips, but you also have to add spread to that. So if the spread is 2 pips, now you're going to have 52 pips take profit. That is how you enter and you set your stop loss. Now, for your take profit in this particular day, on this particular day, your take profit never got hit. So this is where your exit strategy comes in. You have to know how to get out of the market and when to do it. Now, for example, what you want to do is this. Here, you never got your take profit never got hit. So what do you want to do? You want to look closely. Here, we're nearing the end of the day. So at the end of the day, the market makers will always consolidate the market. Look right here, trap, you'll pull it back, trap you into consolidation. Look right here, do the same thing, consolidation. Look right here, they'll do the same thing, consolidation, and even look right here. Going into the next day, market makers will always consolidate the market. That's how they trap traders, not let them get an exit and make them pay swap every time. Now that you know this, you're already up all of these pips, about 40 pips. Let it go. Take this off, book your profit, and call it a day. So if your take profit doesn't get hit, the 2 other options you have is the 2-hour time frame. If you don't understand the 2-hour time frame, you're going to understand that in the future. I can explain that right now. And if you, after the 2-hour time frame, you want to take the trade before the day switches over. As a market maker trader, you do not pay swap and you do not hold trades over the weekend. Those are your rules. Now, let's go to the next day. Next day, they'll do the same exact thing. This is the dead market time between 5 p.m. and 8 p.m. This is where they reset the market. In Asia, when they come on, they throw in your initial low and your initial high right here. Now, in London, they extended by a couple pips, set the low of the day, and then they set the high of the day. Now, I want to explain something very important here. Most of you will see this and say, why didn't I select this at the high of the day? Let me place my cursor right here and show you why. This happened at the exact end. If you look at the bottom of the screen of that line, it says 9 a.m. Now, I want to ask you guys a question. At your jobs, the last 15 minutes before you clock out of your shift, do you do anything? Most of us are just there. When I used to work at the Olive Garden, right before, as soon as my my relief came, I'm just trying to waste time and I'm just trying to get out of there. So that last 15 minutes, I don't consider it. So I use the candlestick that's closest to that. And now this is the reason why I do that. Because once I do that, I know that once the market makers come online, the new market makers in New York, they're going to spike that high. The rejection of that high that's my signal to enter the trade. Simple as that. Everything, the whole market maker method is predicated on timing pattern, and levels. I'm not going to get into all of that today, but maybe in the future I will. Now, with this timing, the minute they spike this high right here and they pull it down, now you have 2 hits to the high. That is your trigger to sell the pair. Enter of the candlestick close, set up your stop loss. You're entering off the high of the day, so your stop loss is 23 pips plus spread. So let's call it 2 pip spread. That's 25 pips. Take profit, still the same, 50 pips plus spread. So 2 pip spread, we'll call it 52 pips. Right there, the take profit got hit before the end of the New York session, before they pulled it back and jammed everybody into consolidation. You were already out the trade. That is how you set your stop loss and your take profit. Your take profit will either get hit, or you will know when to get out as a market maker trader, either by the 2-hour time frame or not getting jammed up into consolidation and next day swap. Now, with this being done, we're going to move it over to the next day. This is going to be the last one I'm going to talk about before ending this video. Right here, what do we have? We have initial low of the day, and here we have the initial high of the day. Market makers extended the high first, and as a rule of thumb, always kind of keep this in mind. Whichever side they extend first in the trending pattern, that is the side they're trying to trap for. So if they extend high, they're trying to trap the buyers and run the market short. If they extend low, then they're trying to trap the sellers and they're going to run the market long. So just keep that in mind. That will help you 7, 8, or 9 out of 10 times, as it's helped me over the last few years. So now we have the low of the day London right here. They hit it here. This is where they set it. When we rolled over to the new session, what did they do? They set up a head and shoulders intraday pattern. All of these things I'll talk about later. For this are just beginner videos. So intraday patterns, weekly patterns, monthlies. We'll talk about sessions, because the market makers work off of misdirect. They have to get 95% of all traders going one way so they can go the other way. Your job as a market maker is to make sure you don't get trapped with those 95%. So now we have head and shoulders to the high. We got 2 hits to the high of the day right here. This is your entry, but this is a pattern. So once you have a pattern, which is a M formation, or like everybody else calls it a double top, we call it an M formation, or W formation, which is a double bottom, or inverted head and shoulders and head and shoulders, your stop losses are much tighter. So instead of 23 pips, now your stop losses are going to be 13 pips plus spread. So that 2 pip spread, that's going to make it 15 pips, and your take profit will remain the same, 50 pips plus spread, and that is it. So really tight stop losses that allows you to be able to get out if that high of the day is wrong. Because if the market maker will only reverse off the high of the day or the low of the day, or high of the week or the low of the week, which we'll talk about moving forward. So there you go. Here again, you couldn't book a profit. As soon as you got right here, they pulled it back and trapped it in the consolidation. Take the profit off, get out. Tomorrow is another day. So I hope this video was able to help you guys understand how to set take profits and stop losses. I'll see you guys next time.